So, Scott, one of my favorite parts of the show is that segment we call House Calls, where we check in with a caller from the past and see if our advice was sound or ridiculous.
Or crazy. Yeah. And there are times we might be out there. Anyway, in June, we spoke with Amit from Texas. He's not an Allworth client, but wanted to know how to invest the family's money for retirement in a tax-efficient manner. And as we talked to him, we also discovered he had been sold quite a bit of insurance. So let's hear that clip right now.
My wife and I are 40 and 37, respectively. Combined gross income of $310,000 annually from our corporate jobs. We currently have $125,000 in Roth retirement accounts that we converted. That is managed by an advisor that charges 75 basis points, and invested very aggressively in genomics and innovation type companies, showing healthy returns. However, we self-manage the rest of our investments, about another 200 in IRAs, 15 in a separate Roth, all primarily invested in low-cost index funds. We have about 4,000 in a 529 plan for our two kids, and then about 20,000 in an HSA that are all also invested in index funds. I maxed out my
Okay, you didn't mention a 401k in there, or are you going to?
The 401k is part of the 205 that is part of our Fidelity accounts.
Okay, thank you.
We max out our 401ks. Well, my wife puts 10%. I max out mine.
How long have you been maxing that out?
I'm sorry?
How long have you been maxing that out?
For the last 2 years.
Okay.
We consistently save about 15 to 20% of our net pay from our corporate jobs. And then beyond that, we own two daycare businesses. One is operational that we are expecting to see about $120,000 annually going forward. Second one's under construction that will, once it's fully operational, we'll get about $150,000 from that. And then my wife will manage that at a $65,000 annual salary.
And is that where your cash has gone? Because you make a relatively good wage, and you don't have a lot saved relative to what your wage is.
Correct. The majority of our cash went into putting the down payment in for the new business, which was around a little under $300,000.
Do you own the property or just the business?
The first one we own both of them. We're going to own the property and the business.
Okay.
So we have some concerns, particularly regarding our VUL policies that we have with our current advisor. We were sold that given our income, we would be phased out, and this would provide you with an opportunity to put more money, almost Roth-like. We do the VUOs.
It's variable universal life for the rest of the
outside of the cost of insurance. All of that goes into S&P 500 index, and we fully participate. We're not capped, and there's not a floor. We're worried about the high fees that our current investor is charging, along with just the high fees related to VULs.
Yep.
Our goal is to build a legacy for our children, as well as save for their college and weddings at some point. So my questions are: one, are these VULs truly beneficial, or is that money better deployed elsewhere given our concerns and our goals? The second question is, should we consider switching advisor to somebody that's a little more proactive from a tax planning perspective and keeping track of our goals?
You refer to these corporate jobs. Your wife works for a large corporation now?
She works for a marketing consulting company, and I work for a renewable energy company.
And what is her income now?
She makes about 95, and then I make about 180 plus my bonus.
And then you mentioned that she's going to leave that and just run the daycare at $65,000 a year. Is that correct?
She's going to keep both.
Okay.
She'll manage. We'll hire directors, but she'll be there from an owner perspective.
Okay.
The plan is to ride both of them as much.
By
as
the way,
possible.
Wealth is created not in passive financial assets like S&P 500, 401k, VUL. Wealth is created in your career. Either you're very talented and somebody pays you a boatload of money, or you create a business.
Or in your case, both.
I mean, if you look across the spectrum of wealthy people in this country, it's very few is inherited. It's primarily in your career, either a business or you're really good at what you do.
What did you say was in the 529 plans?
Let me rephrase that. You're really good at what you do in an area that demands a high wage, because you might be a great violinist and you bring a lot of joy to people's life, but maybe you're not making
this follow your dream stuff is garbage.
Well, I don't know, garbage.
Okay,
you need to get paid too.
The 529
the
plan.
intersection between getting paid and your dreams.
Well, how much is in the 529 plan?
About 4,000.
Okay, and let's dig into this VUL.
Yeah.
What's the...
So, first, a variable universal life policy, the way they're structured, like Pat and I both started in the industry with a life insurance company, 1989 and 1990. We lasted a couple of years. We learned that if you get trained in the life insurance industry, they teach you that life insurance is the solution for any financial issue you're dealing with. I don't care what it is, a life insurance policy is the answer, right? That's how they train all their agents and whatnot. A variable universal life policy is a policy where you put money in to this pool. You can choose how it's invested. So you've chosen to put it in the S&P 500 fund. And then there's a cost of insurance. There's a life insurance, like a death benefit. And how much is your death benefit on your policy?
For the parents, it's $500,000. For the kids, it's $1 million.
Wait, whoa.
How many policies do you have?
Each of the family members have a policy, and then we as parents also have a separate $1 million term policy.
Okay, and is it the same advisor that sold you this that is actually managing the Roth IRAs?
Part of them, yes.
Yeah, the one.
Okay, so let's break down all four policies. When did you purchase these?
Well, let's explain how these work.
Okay, well, thank you.
$500,000 a death benefit on Amit's first policy he's talking about here. And so if there's no cash in there at all, he has an insurance cost of whatever the insurance cost would be for $500,000 of death benefit. Mm-hmm. If he had $100,000 of investments in cash in the policy, he would pay the amount of death benefit would be the difference between that $500,000 and what he's got saved there. The cost, my experience, the cost, by looking at the cost of insurance on these policies, it tends to be a lot more than it would be on pure term insurance.
Yes. So what they call that difference the Delta pure insurance, and that pure insurance is expensive. And once you're in, you can't requalify because they have big surrender. Most of them have big surrender charges.
Plus, there's the internal costs are 2-3% a year.
There's a load on it typically, and then there's a management fee inside.
Now the benefit, what they sell the benefit on these is they grow tax deferred, so you're not taxed at all as things grow. And then when you die, that's tax free. But later in life, you can withdraw your contributions first, your policy premiums first. And then after that, you can take out a loan against the policy.
And as long as you die with the insurance policy in place, it's tax-free. The problem is most people don't die with these insurance policies because the costs actually erode most of the value in there.
The whole concept of using these policies, funding them, and then in life taking a withdrawal, I can't tell. I've been doing this 35 years. I cannot think of one situation where I saw someone with a sizable nest egg in a life insurance policy living off the loans from it.
Well, Scott,
I've seen where they're about to implode, and and if they collapse on themselves before you die, suddenly it triggers a massive taxable event.
You said you and your spouse each have $500,000?
Correct.
And what's the cash value in there?
The cash value for mine is around 65, and the cash value for my wife is around 20.
And how much are you putting into these?
Right now, we're putting $500 a month for each person.
Okay. And you then mentioned that you had two policies, one on each child?
Correct.
And what's the face value on those?
They're $1 million, and we're putting in $300 a month for each child.
Holy smokes! Look, whatever.
How much cash is in those?
My eldest has a good amount, a little north of 30, and my youngest has been recently born, so he doesn't have much. My
experience has been the internal cost of the insurance is more than the tax liability would be.
And why would you buy an insurance policy on a child?
Because it's such a great tax tool.
But the 529 is completely ignored in this equation. There's $4,000 in the 529 plan, and they're putting $300 a month into these policies. Here's what I think you should do. Cancel the policies on the kids immediately and consider it sunk cost. You're going to lose most of the money, or you could actually...
I don't know what it costs. There's a minimum cost every year.
That's
for
right.
These things.
So, but what we do know...
You got to kind of run the numbers.
Is the newborn, you should cancel it. The child that's got a $30,000 cash value, you might want to lower the face value to $100,000 or maybe $50,000, and that way you're buying less pure insurance, and then slow down or stop the deposits completely. But
I was trying to see what the lowest death benefit I can get to without it not being an MEC.
Oh no, you don't care if it becomes a MEC.
Okay.
You don't care. You don't care because the cost of insurance, it far exceeds any of the downsides of becoming a modified endowment contract.
Okay.
So just throw that away. In fact, even on your own life insurance.
You might want to qualify for some more insurance before you reduce.
Talking about the kids first.
Oh, yeah.
Okay. So the kids. So you're on the right path. So don't just see what the lowest face value you could turn those things into.
I would look at if the surrender charges aren't too astronomical, I would just cash the thing out. It's $30,000, a couple grand in penalties. Take the $28,000, throw it in the 529. That's what I would do.
That's right.
And if you really want life insurance, I don't know why you'd want life insurance on your kid, but if you want life insurance on your kid, go buy some cheap term insurance.
You have no need for life insurance on a child. Unless this child is some sort of prodigy, is making all kinds of income that's coming into the family. Life insurance is designed to replace income.
The amount of money we're spending on them, I expect them to be prodigies.
Okay. Well, I don't know. I don't actually know.
Wait till they're teenagers.
I don't know if that's how prodigies work. I don't think you could actually spend your way to a prodigy. So on those, I agree with Scott. I'd look at either collapsing those policies completely, or at least the oldest one child turning into a MEC. Your policies, I would turn them into MECs. First of all, I agree with Scott. I would actually go out and buy some term insurance. And by the way, $500,000. How much other term insurance do you have?
He's got $1 million.
$1 million for each of us.
Yeah,
that's not enough.
I would have at least $2 million.
Yeah, that's not enough.
Okay.
Yeah, $2 million of term, and if you're in reasonably good health, you're 40 years old. It's cheap.
So for both those policies, your policies, I'd either lower that face value as low as I possibly could and turn it into a modified endowment contract, or cancel them completely and just take the hit. The 529 is the thing that you missed. I mean,
well, he didn't miss. He's followed this advisor.
Okay, the advisor missed, and
the advisor didn't miss. The advisor had a misalignment of his economic, I'm assuming it's a male, his economic benefits compared to Amit's economic benefit. There's a misalignment. He earned a commission.
That's right.
How can you be open-minded and actually look for the best solution when you've got this conflict, tremendous conflict?
Well, Scott, I disagree. I kind of disagree. If he had done every other thing, let's just say that he had $2 million in the... Right.
Whatever.
Right. Let's just say we went through the list.
He's either uneducated and doesn't understand the other stuff. He's an idiot, or he's unethical. My opinion,
or maybe all three. But the VULs are the very last thing on the list of a product that you should use. Very last thing, right? Okay. Everything else, the 529 should be fully funded.
Look, with the tax efficiency of ETFs and a synthetic index by a direct index, like why? Those are such.
This is, as I said, the very last thing. after you've gone through every other thing. You're not there. So your idea, Amit, of either
and look, he followed advice.
Understand? That's what he's calling for.
I understand.
He's calling for outside advice.
I just feel bad.
But I don't have a dog in this fight. So the 529. Look, you can convert a 529 plan to a Roth IRA if the child doesn't use it. And you talked about legacy. So these 529 plans should be maximum funded, right? All the way.
Should I have one for both or one total?
You can't. You have to have them separate.
I have two. And what I would do is just how much is it going to cost to go to education, work backwards. How much do I need to save on an annual basis?
Right.
So bring those things to zero or turn them into max. Get $2 million term life insurance policy, 10-year level term at least on you. Fund the 529s to the maximum. And I would actually I'd make them aggressive. Your wife should increase her 401k to the maximum. And you're doing the backdoor Roths. We can see that. I think you're doing great. I think I would clean that up and I'd get another advisor.
Okay. So I just need to fire my advisor and stop paying him. That's what I need.
That's what I would do.
Yeah. Give it some.
Is he affiliated with an insurance company?
He is. Yes.
Yeah. Mm-hmm. Yeah. So all you got is a hammer. Everything looks like a nail.
Well, I'm getting ready to pull my hammer. So.
Okay. Amit, thanks for joining us.
Yep. Welcome back to the show.
Yes, and please bring us up to date. So.
Hey guys, can you hear me? Right?
Yes, sir.
Yeah. So we did kind of incorporate the things that you've told us. The previous advisor, we kind of told him to kick rocks. And we opened up the 529 plan, started putting those in there. Given the amount that we had specific for my daughter in her VUL, we lowered the death benefit to as low as possible. So we're not paying for a lot of cost of insurance.
Just out of curiosity, in running the numbers, you said you kicked your other advisor to the rocks. I hope not physically, but how did you crunch the numbers to see what was best? Did you just do it by yourself, or was there someone else who understood how these policies work in great detail to help you, or what was that process like?
Yeah, so my employer has. I reached out to the benefits provider, and he also has his own business, and he kind of provided some guidance. Didn't charge me at all. And,
beautiful.
He said, given the amount that's in my daughter's, it probably is best to kind of go with that route, and then just max out the 529 at a level that you feel comfortable with your with your kids' future education, so you're not paying for insurance you don't need, and you're not paying somebody else their bonus.
And how low were you able to get that face value on your daughter's policy?
$250.
And that was as low as they thought was reasonable?
Yes.
Well, nice. I mean, he was talking to someone that had no skin in the game, right?
Well, yes.
Right.
And did the advisor that you talked through your employer, did he feel the same way we did?
He provided similar guidance, yes, in terms of, you don't need this for your kid. There's better ways to optimize how you use your capital to kind of grow and invest for some of the things that you want to do for your children and a legacy and things like that, and yourself.
Yeah, and I'm sorry this happened to you, but for the rest of the listeners, life insurance policies are sold as if they are simple, easy investment vehicles.
Yeah, and it's got to tell you. So Pat and I listened to this clip before the show started this morning, and after your previous clip, Pat says, "This stuff is really complicated," and he says, "Can you imagine if the average person called a stockbroker from," and he named one of the big firms I'm not going to mention, and he said those guys would not have a clue how this stuff, and it's probably fair, just because. I mean, one of the reasons we started in the industry 35 years ago, at the first couple of years of our career, was at a life insurance company. We learned the sales strategies that they employed to sell policies stuff like this. Like, oh, you have a kid, let's just get him $1 million
the
life
interesting
insurance.
thing is we didn't do very well there.
Well, no, because we kind of saw what was going on, and it wasn't a good fit.
Yes. And so what did you end up doing with your policies?
We did the same thing. But we also got an extra $1 million for each of us in term. So we're not, we have that covered, and hopefully, by the time our kids turn, 20 and or go to college, and they'll be set in terms of, their 529s, and if they don't use it, that's great. We'll convert it to a Roth and give them a legacy that way. But I think we have the infrastructure in place to kind of not have to worry about this stuff going forward, hopefully.
My guess is the legacy you leave your children will what you do with them on a day-to-day basis.
Of course, that's always a bigger one, of course.
More so than the money. Off topic. Did you guys open the second
Daycare
yet?
We just received permitting for fire yesterday, so things are moving relatively quickly now.
Awesome.
Hopefully we'll close on the loan and then begin construction.
Congrats.
Good for you.
Anything else we can answer today?
No, I think what you kind of helped me with from a thought process and how we should think about structuring this kind of laid the foundation. And now I'm trying my best to kind of be wise with my money as my businesses kind of grow. We'll probably at some point need to. I did hire a separate CPA as well to kind of help tax plan, not only for the future, like next year and things like that, with what's going to come from the business in terms of upfront depreciation losses and things like that, and how we can maybe take advantage of potential conversions and things like that. So, but as the complexity of my finances changes, at some point we will probably need a financial advisor to start thinking about how to strategically take advantage of whatever laws may get passed from now until then. I know direct indexing is something that I'm probably start getting a little more educated in. Right now, I just don't have a lot in the brokerage.
Yeah, I know you got your business. Well, here's the difference. Exactly. So you're talking about a direct index. You're talking about that's a strategy of owning a small stake in businesses that other people started. Mm-hmm. You're instead taking the money and putting it in a business that you're starting.
Right.
Well, obviously, you start a business yourself. There's more upside. There's more risk as well. But I mean,
in this business, is just a bit of advice from someone who Scott and I have opened multiple businesses
and
together,
some of them successful,
and some of them that we still talk about. Don't be afraid of getting too large of a cash cushion.
I do have about 9 months worth of expenses. Probably closer to probably a year. If things go sideways, we obviously would probably cut off some of our children's daycare expenses and things like that. But if I had to guess, probably a year. I guess I did have one question. In terms of thinking through the next, potentially 15, 20 years, what are your thoughts on thinking about creating passive income through whether it's dividends or something else as I get older, as my wife and I get older?
I would say focus more on creating net worth, and then whenever you need income from it, then figure out the best way to generate income.
That's correct.
As opposed to the whole concept. What, you're going to buy fixed income to have guaranteed income?
Or high dividend stocks?
Treasuries or
but
something?
If you think about it, if you can dial 2 daycare centers, my guess is you could dial 4 or 5.
We're doing 4.
Or 8 or 10.
And then you don't have to worry about passive income, because then at some point in time, you got a massive asset that someone's going to cut you a big check for.
Yeah. And the idea of actually owning the properties, which you did already, and then leasing back to yourself is a form of passive income. And then if you sell off those daycares at some point in time, normally what you would find is that you'd probably end up keeping the properties, and that becomes a form of passive income in retirement.
Yeah. And lease them back to the
and
new
you
owner.
lease them back to the owner. You sign a big lease before you sell them.
Because a big operator is probably not going to want to own the real estate.
Most of the time, they
right.
do not. They don't want to own the real estate because it's not what they believe to be an efficient use of their capital. But it might be the greatest use for your capital.
Rather than
in
become a
retirement.
student of how direct indexing works, continue to be a student of this industry that you're invested in. Yes. So you go from 2 to 3 to 4 to 8 to whatever, if that's what you want to do. But in talking to you, if you want to create family wealth, that would be the way to do it.
Yes. Yeah. And obviously, if your wife's working both her regular job and in the daycare, she sounds like she's pretty motivated, or at least you might be motivating her.
I'm probably motivating her. We'll see how it plays out in practice. She might be like, "I'm done. You take over." Or, "Hey," she might quit, or she might. Yeah, we'll have to figure out how that works. But
well, it sounds like
I do think that lease these things are very capital intensive, and we own 2 of them. And if we feel like we're always on edge because we're dropping all of our savings into the next one,
you're investing. You're investing in them. You're converting from savings to an investment.
Fair point.
Yeah.
They are capital intensive, so we might look at we own 2. Does it make sense to maybe start leasing? But we're going to have to run the numbers in terms of what the rental rate is and things like that.
Correct. Or enter into lease options to buy, which allow you to actually develop the properties. And so the problem with not owning them and actually signing short-term leases on others is it's really, you could call it a daycare center, but really it's a retail space that people bring their children to, and they get used to it, and it becomes a brand. And the problem with not owning, or
it's a little
at least
different than an office
long-term
building that's on floor 5 in a building.
That's right. They become their own personalities, if you will. And the location matters. It really, really matters. And so what you don't want to do is sign a short-term lease and then get priced out of that particular location as you've built up a following.
Suddenly a mile and a half away.
Yeah, we're looking at 15-year lease with 2 5-year options with a first right of refusal after year 3, which is typically when we ramp up to capacity.
That's actually that is a decently long lease.
That's a long lease. Mm-hmm. Then you got to ask yourself if you want that personal guarantee for 15 years.
Yeah, and are there outs in it?
But the plan is not to be involved. The plan is to structure a management team that kind of runs the day-to-day.
Oftentimes, when you have a small business, the landlord will say, "That's great. I'm sure your business is going to do well, but we'd like a personal guarantee." Mm-hmm. So I'd be really careful. Personally, I would not want to sign a 15-year personal guarantee.
Got it.
I would try to negotiate something. I'm happy to do it for 3 years or something like that. And then,
yes,
unless it's managed by some massive REIT or something like that, the landlord's going to have, every lease is different.
Yeah, and just remember, you sound like you're an engineer by education or computer science, somewhere along those, right?
STEM. I'm a CPA by trade.
Okay. All right. So as I always share with my kids, I said everything works perfect until you involve people. The spreadsheet was beautiful. Right. So just remember that.
And wish you well.
Yeah. Congrats. You've done great.
Amit had someone he was working with, a financial professional he was working with, wondered, is this really the best? Reached out to us, got a second opinion, then went to somebody else, got another opinion, and with a little bit of advice and changed course. So if you've got something in your financial life that you're kind of thinking, is this the best for me? Get a second opinion, whether it's from another advisor or this program.